Welcome back to another episode of SaaS Buyers Club. I'm your host, Omeed. I am managing partner at Optimist Legal, which is a corporate boutique law firm that works with SaaS founders. We help them from incorporation to exit. Anything that has to do with contracts is what we help SaaS founders with. And I'm also the host of the SaaS Buyers Club podcast. And today I'm going to be interviewing Steph from OpenVC. And Steph sits at the intersection of corporate innovation, tech entrepreneurship, and venture capital. He runs an app that helps founders get investment, and he shares a ton of content on helping founders to get investment. So I'm really pleased to welcome him on the show today.
Hi, Omeed. Hi, everyone. Thank you for having me.
Steph, what did I miss? What else do people need to know about you and OpenVC?
You've covered it all. I co-founded and I run OpenVC. We're a software company. We're an app that helps connect founders and investor. We're called OpenVC because we work with an open model, which means that we don't charge any success fee or anything like that. We're not a broker dealer. We are more of a community service, and I would say that 95% of what we do is free, including a lot of the tools that we build and a lot of the content that we put out to help first-time founders and early-stage founders, close their pre-seed or seed round. More recently, you probably don't know that, we recently launched our own angel syndicate. So we also invest now. That's a new activity for us. And I guess it's a natural evolution. But the bottom line is that, personally, I love talking and helping founders through that fundraising process. And we have a lot of SaaS founders on the platform. It's probably the number one most represented segment on OpenVC. Maybe 20% of the startups on the platform are SaaS companies. So, and we're ourselves also, to some extent, a SaaS company because we have some premium features sold as a subscription. So we could say we're also micro SaaS ourselves.
That's awesome. Why do you love talking about investment for founders? What is it that makes you love that?
I guess it's as often, it's a journey. I've spent 10 years in that space. Started my first job out of business school was at Microsoft. Well, at the time it was called Microsoft Ventures, but it was really a startup accelerator in Paris, run by Microsoft, and that's where we helped first few batches of startups get funded. So that's when I, got my first foray into this space. Then I moved to the US, San Francisco, worked for a niche firm in consulting that was, at the intersection of innovation and venture capital. So worked with a lot of local VC firms, including some tier ones that everybody know. We helped them connect with some of our corporate clients in Middle East, in Europe, in Asia. So again, I was, sitting, I had the back seat on some really cool startup pitches, trying to sell stuff to really big clients, and all of that happening in the offices of some big name VCs. So that was step 2. And then step 3, started my own company, raised funds for a first deep tech startup that eventually failed. I've seen it all. I've accumulated a lot of thoughts and opinions on the topic.
Mhm.
And then I just, put that all together and try to share with founders. I guess it's a natural thing. When you see stuff, you see a lot of people also attempting it and struggling with it. And so the natural inclination is, okay, I'm going to share my experience. And if I can build tools and help with that as well, it's just what I do.
Yeah, so you got to see some awesome deals. You've been a founder yourself. You've been in the VC
I've done
space,
it
it
all.
sounds like, for quite some time. What do you want founders to get from today's episode? Like, what is the main takeaway that you want them to take away from the episode today?
Okay, so in a few words, if you raise to win. If you decide to go the VC route, try as much as possible to de-risk that option and make sure that, okay, we're in a good position to raise. What I see working now with, I can say thousands of startups trying to raise. A lot of them, when they don't raise, it's because they were not really fundable in the first place. The founders were hardworking, no denying that. They were working super hard, took a lot of risk, personal risk, right? But they just didn't know enough about fundraising, about venture capital. They were first-time founders, and they saw some TechCrunch headlines, and they saw some tweets about someone raised, with a pitch deck and with just an idea. and they just didn't see all the subtext that, yeah, this guy raised on a pitch deck, but he had 2 previous exits, right? And so he had a track record, and for him, it was obvious he would close even before he starts raising. And there's a lot of, basically, fundraising is sexy and fundraising is, I don't know, fashionable somehow. And so a lot of people jump on the bandwagon and they get badly burnt. And what I always try to tell people, for their own good, because I don't care at the end of the day if they raise, I care if they're successful. That's 2 different things. And you can be successful without raising, or you can be more successful by postponing your raise to the right moments when you're highly fundable, very sexy for investors, and your raise will take 3 weeks instead of taking 9 painful months. So this is really what I try to convey, and there are many aspects to it. We can talk about, traction, track record. We can talk about your fundraising materials. We can talk about the process. We can talk about intros. Like, there are so many little moving parts. But the big picture is founders who've never raised are over-optimistic because it's their nature, right? You're not a founder if you're not over-optimistic. But unfortunately, that usually doesn't work so well with fundraising. And you need to do your homework and only start raising when you're, most of the lights are already green. And that's really what I try to convey with my content.
It sounds like the place to start this conversation, you said that a lot of founders don't know that they're not fundable, right?
Yeah.
So how can a founder know whether they're fundable?
Okay, simple. We're going to split it into 2 parts. First, what does a VC want, like in absolutes, right? And a VC or a venture capital investor wants a company that can, if you invest at seed, can 100x, like 30x to 100x their check within 7 to 10 years. So if I invest $1 million in your company today, in 7 to 10 years, I'd like to get $30 to $100 million in returns. Like, these are really high numbers, right? This is not a normal thing. This is not a natural thing. And there are a few typical traits that you would be looking for in a company that could be able to achieve that. Market size, right? You need a very large market size. If you're selling in a space that is worth, $1 billion, it's unlikely your company will achieve $1 billion valuation, because it would mean take 100% of the market. They're looking for scalable models that are capital efficient, which means SaaS. But, like, the most pure form of that is, I'm a SaaS company, because high margins, low marginal cost is almost zero. Just add another user. If you're a SaaS company, you probably tick that box. The market size is another one, etc. So you have a few like typical traits, and you might have a business that is a very good business cash flow wise, but it's just not VC fundable. So that's the first thing. And then the second part is, your business is, as a model, VC backable, but maybe you don't have the track record and the traction that investors want to see. When you think about your startup, it's like people, the way they think about their babies, right? Your baby is the most beautiful in the world. And I'm sure you've seen people show you photos. Look at my baby. It's the most beautiful baby in the world. And you see this kind of troll with a deformed face, and a blue skin. Okay. So it's the same thing with startups. You ask founders, their startup is a perfect investment opportunity. But when you're on the investor side and you see 5 to 10 decks per day, 5 to 10 decks per day, then, it's like anything in life. You start just developing kind of distance to those things. You don't get so excited, and you have this kind of cold framework that you apply to everything. So you're going to ask, okay, what is the track record of the founders? Do they have previous success? Do they have some past exits? Do they have they been through any, competitive selective program, maybe joining a top school or top company, or, having a non-trivial position in a VC-backed company before, so they know what they're talking about. And you're going to look at the traction, revenue, user retention, basically anything that can indicate product market fit and current success. So it's what I call like past success and present success, right? Track record, traction. And these are the 2 legs of whatever you're going to do with VCs. They want to see that. So basically, a startup that would have this and that has a VC backable model is probably fundable. And otherwise, it's more tricky. We actually built on OpenVC a test that is free to take called the Fundability test. So fundability.app, it's an OpenVC tool. and you just answer 30 questions, and we're going to tell you how you rank in fundability. Are you top 1%, top 10%, top 50%, against all the thousands of companies we have in our database, right? And so you're going to say, okay, am I sexy for investors right now? And if not, it's fine. It just means, okay, I need to fix this, I need to fix that. I need to maybe give myself 6 more months, improve my traction, improve my retention, whatever that means. But yeah, that's what I mean with fundability.
Got it. Okay, so we have tackled fundability, and that totally makes sense in terms of track record and traction.
Right.
Yeah, past, present. Totally makes sense. And my question always when this conversation comes up, though, is like, as you mentioned, every startup founder thinks that their baby is not ugly. They think their baby is the most beautiful baby in the world. And it's important to have self-awareness, but self-awareness is like such a soft concept. That's why I love that fundability test that you have. So I'd be super curious to take that and see what some of the questions on there are. So if you're listening, make sure to check out that fundability test. It sounds super awesome. I'm definitely going to check it out. Let's continue down the path of what you want people to take away from the episode. So you said that people don't know whether they're fundable or not. And so there are serious implications to raising VC, which almost has the sense that there are business owners who should not be accepting VC who are accepting VC. Is that something that you see?
There are many typical scenarios of that, some worse than others. So we can walk through a few of them. So one of them is a founder who thinks he or she needs VC funding when they could probably bootstrap. And typically in SaaS today, if you're building what I call vanilla software. So vanilla software is, a simple SaaS product, a simple mobile app, something that has, a screen, a database, and like something very simple, a Chrome extension. You probably don't need VC funding for that today. Not to build. You may need to scale, but you probably don't need it to build, because with no-code tools, low-code tools, and AI, like most of the product building has been streamlined, and cloud. I mean, now we take it for granted, but it was not 20 years ago. And cloud as well. You can build a lot with very little, and you can de-risk the project on your own. And why would you spend 6 months chasing VCs to finance you to build an unproven product when you could spend that time, just building, shipping, and getting market response, and increasing your valuation in the process, obviously.
So what I'm getting from there is for tools that are lighter to build and launch, you don't necessarily need pre-seed funding, for example. Pre-seed funding would be better for something that needs more development, more investment to necessitate the need for that pre-seed investment to just get the product out, like not even necessarily product market fit, but literally just to work on the product.
Yeah, and once the product is out, if you're doing software, distribution, unless you're doing enterprise sales, distribution is probably not that expensive, because you have Google Ads, you have Twitter, you have LinkedIn, you have cold emailing. So anything that sells under 50K ARPA, you can probably, you have a fairly accessible distribution channels, is what I'm getting at. So product building,
got it,
and distribution is probably easy for vanilla products. If you're doing deep tech, if you're doing biotech, I'm not going to say that. Web3 is also very expensive to build it. Some fintech, if there is regulation, if you might need some banking license, that's of course a different conversation. For most SaaS products, you probably don't need VC funding to build. It's a new thing. I wouldn't have said that 5-7 years ago, but today it's increasingly the case, and people are just catching up to that. People are starting to realize, both founders and investors are starting to realize, okay, there is like the bar is moving, and so maybe now the bar to raise is going to be higher because the bar to build is lower, right? So,
Mhm.
but it also
Mhm.
means that a lot of people, and that's maybe the second case of people who shouldn't raise VC money. A lot of people will realize that, okay, you know what? I can build, I can sell, and I can have a cash cow for myself. Where I thought in the past I would have to build a VC company, VC-backed company, because I need the funding, and then I'm gonna have to go big or go home, and take all that risk to grow crazy. Now, why would I do that, right? I can have a SaaS company that just prints money because the cost of entry to that space is accessible, and they just realize, okay, I don't need VCs at all. I decided to go as a bootstrap company. You know what Mailchimp has done? They sold for $12 billion, I believe, fully bootstrapped. Took them 20 years. I guess if I had to repeat the same thing today, it would take them half the time, right? Just because the world has changed and a lot of stuff today exists as bricks ready to plug, as opposed to I need to code stuff from scratch. So I think we're going to see a lot more of that, and investors will have to adapt, because founders, sophisticated founders, enlightened founders, will realize, maybe I don't need VCs anymore. So that's the second category, probably people who shouldn't raise. And the third category are people who just don't like oversight, don't like sharing the wheel with someone else, or
Mm.
backseat drivers. And so, if you get VCs on board, you have to accept that, okay, you're going to have people kind of contributing to the direction of the company, and you have to be on board with that. And if you don't like that, if you want, I know some founders are like that, right? A bit control freaks. I'm a bit of control freak myself. But then if you raise funds, you have to adjust, right? And that's part of the deal when you raise funds. So yeah, these are people who probably shouldn't raise.
Vanilla no code platforms are low barrier to entry.
Mm-hmm.
Bootstrap founders, and people who hate having a boss.
Yeah, which is fine. I'm not judging. I'm just saying, like, you'll be miserable. Your investors will be
Most
miserable.
entrepreneurs
Yeah,
hate having a boss.
that's fine. That's fine. But yeah, it's one of those things. But some founders, honestly, also are really good at that VC game. They manage to get extra resource, grow super fast. They love the kind of VC politics. They know how to leverage that to their advantage. So it's just different types of personalities, and some thrive in a VC-backed environment. They love, like, for example, having to burn more than they earn, right? It's exciting for them. And some people, it makes them sick, because they're like, that's crazy. Why would I do that even if I have the cash? So don't go against your nature, right? Know yourself, and then you'll see if VC funding makes sense.
Yeah. Or take a pilgrimage to like a yoga studio in India or something with Steve Jobs and the Beatles, and that'll help too, or something. I don't know. Okay, two things are coming up. I actually love what you just brought up about founders that are incredibly successful at being VC backed. I want to dive into that, but I also want to continue down the path of what you want founders to take away from the episode today.
Mm-hmm.
So let's tackle first, like, how founders can crush being VC backed, because I think that's a really interesting concept that you just mentioned, that some founders really thrive with having investors. And what are the keys to that? And how can founders be that founder that crushes with VCs?
I usually I write a lot of content on my blog, and
Yes.
I never wrote a post on that, so I don't have a well-structured answer. So now,
okay, let's
that's fine.
go for it.
I'll go with the flow. I'll have to. When you raise VC funding, you're making a pact, right? I'm not going to say a pact with the devil, because it's not what it is. You're making a pact with investors that we need to grow, revenue 3x per year in the first 2 years, and then 2x for the next 3 years. That's kind of the, triple, twice, double, thrice.
Triple, double,
Exactly.
double. Yeah.
That's this thing. So to get there, again, this is not a natural kind of growth, right? That's why we don't call it organic growth, right? It's funded, it's external. This means that you will take risks, and you put your company in danger in levels that would be unacceptable to a responsible business owner. This also means that you have higher reward if it works, but higher risk. I'll give you a real example. A friend of mine, German founder, raised $100 million for his company over 5 years, has been very successful. and then at some point, not successful at all, company crashed. He left with nothing. He made zero on this company. Spent 5 years, made zero. Now he's doing other things and he's okay. But now, depending on where you started in life and what your situation is, this is an acceptable risk or not. And what I found, it's maybe not very popular thing to say, that you're better off taking VC money if you're already yourself somewhat wealthy and successful, because you can accept the downside much more easily. You can say, okay, look, if this thing works out, this VC company works out, my startup works out, I'm going to be a billionaire. If it fails, well, I still have my house and I still have, my full 401k or whatever it is. Like I'm not on the streets, right? What I found is really difficult is for founders who come from very underprivileged background to raise VC money. And again, I realize this is not a popular thing to say, but is the risk to reward ratio is probably not acceptable for them, because if they fall back, if they fail, the cost is too low, right? They've built 3, 4, 5 years and they have nothing to show for it, and they go empty-handed. Honestly, financial security, your personal wealth, financial security is an important aspect of, okay, I can handle that. I can live with that level of risk every day and wake up every day and make decisions that are too risky every day. So that's one.
Got it. So the first one, it sounds like the first thing that would make founders crush being VC backed is tolerance for risk. And also, it sounds like within that tolerance for risk, almost as like, in the concept of investing in crypto or stocks, people have a saying. They always say, only invest what you can afford to lose.
I love how you summarize what I say, and you say it better than me. Thank you, Omeed. Yeah, that's exactly what I meant. Yeah.
Yeah.
And the obviously the corollary of that is that you're excluding a lot of people from VC funding when you say that, right? But there's also a lot of, like, 99% of people want to raise funds and fail. So maybe it's not a surprise, because the bar, anybody can, decide to chase funding, and maybe not everybody should, and just for their own sake. And that's again what I preach all the time. If you go to raise, you go to win, which means you've done your homework before, and you don't guess, you don't hope, you're not gonna work for it. Just know as a fact that, okay, 80% chances I'm gonna raise, right? I'm gonna close that round. Yeah, and the second thing is like that makes a founder crush it is understand that model. Very few people, and that's interesting, very few people, founders and investors, have actually spoken with, unicorn founders, like truly know and have worked with them and have interacted with them enough that they even have this kind of pattern recognition in place, where they can say, okay, I know what how $1 billion company runs and how $1 billion founder behaves, right? Everybody's chasing those people, but how many have actually spoken to 10 of them or 20 of them? So I think an important aspect, if you want to become a successful VC-backed founder, you live in that space, and that's why, living in a place like San Francisco is so important, because you're going to have more exposure to that. This is something I realized when I moved there. You're going to have more exposure to these types and the way people think. Coming from France, I had very different belief system and very different ways to approach things, more of a scarcity mindset. And when you evolve in that bubble over there, which is not the real world, let's be clear, right? The Bay Area is a very special place. It's like this kind of abundance mindset and approach to everything is completely different, right? People don't care throwing 50K at a problem to solve it. It's chump money over there. I would not do that before. And this is also something I've seen, for example, tier one VC firm in San Francisco, in the South Bay. They have this guy who is an absolute killer in enterprise sales. Okay. So the guy, he has run, so they basically bring him after they invest an A round in a startup. Right? So they bring the round into the startup. They say, okay, we have a winner, but now we need to scale up the sales. So they bring the guy. The guy brings his team of 4 or 5, loyal guys he always work with, guys or girls, actually. And he negotiates kind of package for all of them. They join the startup. They stay 2 to 5 years, right? They deploy the playbook. They set up, they put everything on track. They bring the startup, like I said, from 1 to 100, and then they move on to the next startup, and they rinse and repeat.
I love
And
models like that, man.
I know. And these guys, they only work with that firm. I cannot say, but it's one of the really big names out there. And if you check their portfolio, you check their LinkedIn, you will figure out who it is. Because you'll always see this guy after Series A join any startup, SaaS startup that sells 100K more per year, and repeat that. And every startup has been either acquired or IPO'd successfully. This is impressive. And yeah, surround yourself with winners. And that's, by the way, a side comment, but I'm French, European, and a lot of people in Europe try to duplicate Silicon Valley, right? We try to, okay, how can we create such a successful tech ecosystem? And they try a lot of things, but the really hard thing is you don't have enough people who have had that initial success that can then re-implant into new companies and run the playbook again and refine it and improve it. And you need those people. And that's not so easy. And actually, when we have some successful people, they move to the US rather than the other way around. So if someone's successful, they're going to be brain drained outside of France. And so that's why it never works, because we don't have that. We don't have the people to run that machine predictably and repeatably. So yeah, surround yourself with brilliant people, and don't be afraid to step one to lose. You need to have this all-in mentality.
Cool. Let's go back to talking about raising to win. So we have identified what is a VC fundable business, because you said that you've seen a lot of people make the mistake of raising VC funding when they are not fundable. So step one is determine whether you're a fundable business or not, and you have a fundability test that you can provide people. So if you're wondering whether you're fundable, take the test, and let's continue going down the line of raising to win. What are the other keys to raising to win?
So we have done the most important part, which is we have a VC fundable model with traction and or track record to a level significant enough that I'm sexy for investors. So I'll take this for granted. So from there,
that needs to be a t-shirt. Sexy for investors.
That's a good one. Yeah, I actually, I think we're gonna make this one happen.
I want one. Give me one.
Yeah.
Give me one.
Yeah, sexy for investors. Yeah. So, but that's exactly what it is. Okay, so we have the fundamentals in place. Now it's about executing the raise, and there's a million little details. So it's gonna become like a checklist. Okay, you're a lawyer. I'll take one example, and you'll tell me you're the lawyer. I'm not the lawyer, but I'll ask you a legal question. I'm an LLC. I want to raise with US VCs. How does that sound?
It's probably not going to work.
Okay.
That's definitely not going to work with VCs. Yeah.
Okay. So I get I get harassed on LinkedIn when I say that. There is what I call the LLC army that drops in my comments and say, why, where I'm an LLC, I'm fine, I should be able to raise, and I understand why they say that, because I understand where they're coming from. But, there's just a million little, signals that you're sending. And if I open your deck and the first thing it says is, whatever LLC, like company name LLC, you're already sending a kind of negative signal, right? That, okay, you don't exactly know what you're doing. It's a lot about that, a lot about getting the signals right. So we can go through the whole checklist, from valuation to round size to pitch deck to investor list. But at the end of the day, all it comes down to is showing the right signals that will reassure investors and get them excited. And that's kind of the common thread through all the million little things that you're going to do. So when you're going to design your pitch deck, when you're going to make it short, and to the point, and cover all the key points like market, traction, team, blah, 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 This is about telling the investors, I know what you guys are looking for. I understand the game we're playing, and I'm ready for it, right? When you're gonna, if you're gonna cold email investors, you can actually raise on cold emails. I have many real life examples that I've worked on. Of course, intros are better, but if you don't have intros, then the next best thing is cold emailing. And the way you're gonna structure it, you want to start, for example, with, I'll give an example again. Dear investor, okay, I've already closed the email, right? If you start with dear investor, I already know this is spam and you don't understand the social codes. So I'm not even gonna, or dear sir. Well, you would see that with like Indian founders a lot because it's more formal over there. But if you're raising from
Right.
US investors, you have to adjust to the social norms. And you have to show that you're smart enough to understand that, or informed enough, whatever. And then,
So what do they say? Yo, what's up, man?
no, hi
Is
plus
that-
first name, right? Or hello plus first name, right? Like, but just not.
Yeah.
Well, and I know it sounds like obvious, but I'm telling you, being at OpenVC, we process, I don't know, 5,000-10,000 outreach per month, right? And we screen them individually, and we pass or fail them before very rich investors. So we make sure investors don't get spammed. That's how we build trust with both sides. That's like 50% of founders make this mistake because, again, anybody can anybody can be a parent, anybody can be a founder. So there is no license. And so they make this basic
Or
mistake.
test.
Or test.
Other than product market fit.
Yeah. Well, you can claim yourself a LinkedIn founder. You don't need product market fit for that, right?
That's true. That is true.
And you can spam investors without product market fit, which is what most people do.
That is also true.
Yeah.
Yes.
You won't raise, but you can try. So yeah. So back to your question. Let's start with the basics, right? So round size, valuation. You just want something that makes sense. It doesn't have to be very mathematically accurate, but there are market standards. So you say, okay, I'm a SaaS company. Let's take a SaaS example for your audience. I'm a SaaS company. I'm making 20K MRR, growing 20% month over month. Yeah, I'm probably good for a pre-seed. I can probably raise I don't know, 1 million at a, well, maybe I'm thinking in French terms now, but let's say 1 at a 4-5 post-money valuation, something like that. I'm probably gonna raise on safe, right? I'm probably not gonna do a price round. So these are simple things you just want to have in place. Moving on. So legal stuff, Delaware C Corp, obviously. Oh, by the way, asking you, and this is a real question, I don't know the answer. Do you see a trend
Sure.
of people wanting to move to Texas rather than Delaware because of the Elon Musk drama?
So, I mean, when people come to us, like, we just say Delaware C Corp because it's the most well-known jurisdiction for entity formation, and most VC funds and VCs in general are very familiar with Delaware C Corp. So people actually usually come to us asking where they think that they should go, and they just follow our advice. So we haven't had any founders come to us, and we've done like 3 conversions in the last month from LLC to C Corp. So we don't have founders that come to us and are like, I want to incorporate in Texas. Like, I haven't necessarily seen that. People usually ask us, and then we'll say Delaware C Corp is the way to go.
So it's still the gold standard, right?
Yeah.
And about
Yes,
those
very much so.
conversions. Sorry, I'm taking advantage of you now that I have you.
Please. I love it. I love it.
So have you seen? So my understanding is that it's easy to convert an LLC to C Corp as long as there is not too much history and weird stuff happening.
That's correct.
So what would be the typical time frame and budget range for this kind of conversion? And I'm asking that because I have this question a lot all the time, and I'm not a lawyer, so I don't know what to answer.
Yeah. So a typical conversion will cost $5K. And as you mentioned, it's if the company, doesn't have a lot of documents. Let's say they, went to LegalZoom and they started as an LLC, or they went to Stripe or Atlas or whatever it is. And that's what they used to incorporate. And so the LLC, for example, might have the operating agreement. It might have the membership purchase agreements for the initial founder, for example, or it may not have that. It only may have an operating agreement. They probably have some vendor agreements. Maybe they
Mm.
use an outsourced developer, for example. Maybe they have also some marketing agreement and maybe like a few consulting agreements and some like 2 employment agreements for
Okay.
like devs that work in-house. So something like that, like still, as you can see, that's quite a few agreements there. That's,
Yeah.
8, 9, 10 agreements. So that's still quite a bit of work. It'll cost 5K. Time frame, usually about 2 weeks from end to end, I would say, is like, for all the documents that need to go back and forth. Usually there's a conversion that needs to be filed with the state of incorporation, and then Delaware needs to acknowledge the conversion as well. And then you get to work on reissuing the company documents. So the stock agreement for the founder, the bylaws, and then you would need to redo the contracts, the employees, vendors, and contractors. So
Okay.
you're looking at 5K, about 2 weeks end to end.
That's great. I'll ask you to make a short of this, and I'll repost it every time someone tells me I can just create an LLC and reincorporate. Yeah, you can do that, but it comes with extra cost and extra work. And if your plan is to, raise funds and you're building a VC-backed company, it's probably cheaper to just start as a C corp, I guess.
Yeah.
Okay. Well, thank you for that.
Yeah.
What were we talking about?
We were talking about raising to win.
Okay.
Raising to win.
Okay. So
And you were talking about the checklist
yeah.
and the point of the checklist. So we had covered no hello, sir, or dear investor. You want to be sexy for investors. Okay.
Yeah. So you want to be sexy and you want to be as vanilla as possible. So
okay.
the
So you don't really want to be sexy. You want to be vanilla.
well, okay. These are two separate things. So when I say Delaware C corp, that's what I call vanilla. You don't want to come up with
Okay.
an exotic, Michigan L3C structure, right?
Right.
You want to be special and unique and differentiated with your product, with your go-to-market, with your brand, of course. But don't do anything, don't reinvent the wheel with your finance or with your legal. All of that is like there are standards just for the standards, because otherwise you're going to scare away investors. Valuation goes something that is in line with the market. You're a SaaS company, like I said, for this amount of revenue and growth, this is what the market accepts, and just just be vanilla with that. Moving on, so investor list. I usually recommend to focus on 4 criteria when you look for investors. Geography. So you want investors that invest in your jurisdiction. Check size. So if you're raising, 1 mil, there's no point talking to investors who start at $5 million checks. You're wasting everybody's time. Stage. Some investors prefer pre-revenue, some prefer post-revenue, some even later, some ID stage. So you should filter for that. And by the way, when they say ID stage, usually the fine print is ID stage with previously successful founders, right? So ID stage with 2 times exited
Track record required.
Yeah. So they want to be the first
Previous
checking.
experience required.
Yeah, exactly. And a lot of
Yeah.
founders don't. That's exactly what I say when I mean read the fine prints or read between the lines. And founders, honestly, I have like at least once a week, founders saying, "Hey, all these guys say they invest at ID stage. Why do I get 0 meetings?" And the answer is, yeah, not your idea, somebody else's, right? which is yeah. But they will not say that. Another side note, but most investor communications is geared toward the top 10% of founders, because that's who they invest in. So almost everything a VC says doesn't make sense, or isn't productive, or is maybe counterproductive for 90% of founders, because they're not there yet, they're not fundable yet, and they're not the target. So most of VC communications is, so for example, when VC say, yeah, you don't need a financial model, right? You don't need a financial model. You just, yeah, because they're talking to founders who are already very experienced, who can read a P&L and can read balance sheets and understand their metrics from top of their head. And they can do all this naturally because they've had a track record in that space. But for most founders that, have no business experience, first-time founders, I found that it's actually very helpful for them to have a lightweight financial model to understand how everything flows how money flows through the business. And so advice is always contextual, and a lot of VC advice is out of context, and it's dangerous to some extent to most founders. So it's always important to understand who they're speaking for, and it's usually not for most founders. Okay, closing that side note.
That's actually a really, really important point. That's a really, really important point for founders that I think it honestly is an overlooked point. Because of the fact that, know who you're learning from. Like, does the advice actually apply to you?
Yeah.
If the advice doesn't apply and you go and apply it, you're not going to get the result that you want. So that's super important to understand.
Yeah, but the problem is nobody will tell you, because it's very hard to tell you, where you sit on that hierarchy, or are you good or bad, right? And it's a moving thing because we learn. Something I realized recently, I've been more now for 10 years in that space. What you plan for is unlikely to happen. So you're building a startup now, it's unlikely to become a unicorn statistically. But what happens is that if you're persistent and improve continuously over time, you will end up winning. And I'm starting to see people that I actually started working with at Microsoft 10 years ago, when their first startup and my first, accelerator experience, and their first startup, maybe had a small exit, but now they became an investor. And so now they're a successful investor, right? But this was the first step to their career. The other guy, first startup didn't work out. Then he joined a YC company as employee number one, and then was brought up as late founder because it was great. So and then the CEO left and he became the CEO of that company. And so there are so many trajectories. The thread is always excellence and consistency over a long period of time. So, and for another guy, his first startup failed, his second startup succeeded. Classic, story of persistence. Entrepreneurship is more like a career
success
path.
Compounds over time.
Yeah.
Success compounds over time.
Yeah, thank you. You got it.
Yeah.
In
Another headline.
Yeah. Success compounds over time. Entrepreneurship is a career path. And a lot of people, they hang everything onto raising that VC round. And a lot of founders who lack maybe that critical distance, they say, okay, if I can raise that seed, then suddenly I won. Right. And it's kind of, there's a before and an after in their head in how they frame it psychologically. And everything hang onto that raise. Successful founders and experienced founders that I've worked with, the raise for them is more of a fluid process. So it's a flowing process. Like, they can raise now, they can raise later. They have, they're executing anyway. It's happening anyway. And they are on a more long-term trajectory of success. And that's why I told you earlier in this podcast, my goal is not necessarily to get people funded, because I don't know if funding is actually what will make them successful. And what I care about is them to be successful. And being successful doesn't mean that you're going to get funded, or going to get funded a lot, or going to get funded now. It's this is just one variable in a more complex equation that unfolds over 10 plus years. And
I love that.
And that's only something I'm starting to see now, like after a few years doing this. I couldn't see it 5 years ago. And then it brings a lot of peace, also personal, inner peace. When you say, okay, you know what, I'm just going to trust the process. Another headline, trust the process. Just keep doing consistently great stuff. And at some point, things compound and it pays off. You just don't know. You just have to trust the process, because you don't know what success will look like for you.
Yeah, but it does sound like there is a process, and the process is specifically what we see from successful founders for example, have a track record. As you mentioned, they're just going to keep executing, whereas if you juxtapose that against many first-time founders' psychology, what I heard you say is a lot of first-time founders put a lot of emphasis on the raise. There's kind of like before the raise and then after the raise, like some like life-changing event happens and they transform into, their final form of Pokemon,
Yes. That's exactly what it is. Yeah.
Yes. Whereas successful founders are much more nonchalant about it. Like, it's like, And actually, most successful founders that I know, they're like, yeah, they mostly fall into the bootstrapper mentality where they're like, why would I raise money? I know that I can be successful. But they recognize, I think capital gets properly placed as a tool as opposed to a saviorship.
Yes, 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 yes. Yeah, exactly. Like they don't need it to build, right? They're executing regardless. And if they get capital, it's an accelerant. It's a tool. But it's not a status thing. I think this is also a very important one, right? They see capital for what it is, right? VCs are capital allocators, and this is just a cell in a spreadsheet for them, and it's time compressed, right? That they're buying, but they're not like, okay, now finally I'm in the club, and then it completely changes how your brain works, and that's when you start. I think that's why SBF was so successful, right? Because the guy was so detached, like on investor calls and stuff like
Mhm.
that.
Yeah, he was like
Uh,
playing World of Warcraft on one of the investor
right?
calls, like for his like
Yeah,
series B or whatever. I don't remember which one.
yeah,
Did not give a shit, like
yeah.
at all. Like,
This is really smart because it it mimics the behaviors of you know successful, confident people. Like, yeah,
mm,
I don't need the money. I'm just here for a casual conversation. You see that first time founder shows up to the investor meeting with their slides. They're gonna stand up like a student in front of the teacher and recite the lesson,
mm,
right? Experienced founder, okay, we sit at a cafe, we have a normal conversation. Two people discussing a business opportunity, good fit, bad fit. The slides, yeah, you want the slides, there are slides I sent you before, but I'm not here to recite the lesson in front of the class, right? And there is this kind of position of strength where you want to be, and a lot of founders, yeah, don't get that. I mean, they get that after some time. They understand that there is a power dynamics at play, that you don't want to put yourself down, but you don't want to be arrogant either. You just want to be on the right footing. But yeah, the perspective of raising funds kind of twists people's heads, and they get a bit carried away sometimes, or if trying to, I don't know, play a role that they believe they have to play, which is always awkward. Um, Again, this is not something you learn in school, right? This is like not something you learn at home. Like, it's a very, very niche, unique activity, venture capital, and I think a lot of people just don't have reference points. The one reference point I like, and have you seen these Silicon Valley episodes where they go to pitch VCs with hostility and rudeness? Have you seen that one? It's
no.
amazing, man. I shared it on Twitter. I got, I think, 2 or 3 million views on this one. It's just basically they go to several VC firms to pitch them, and they get more and more hostile and aggressive. And the more they do that, the more the term sheet value increases.
Gets
Yeah,
higher.
yeah,
Yeah.
yeah. Because you have to be insufferable to. So yeah, it's kind of the same idea.
That's hilarious. I'm gonna check that out. I'm gonna go on your Twitter and find that video. That's hilarious. Um, okay, cool. So to circle the conversation back, we were talking about raising to win. We talked about how there was like a side note there that we just covered about the importance of detachment in the process and recognizing how capital is really just a tool. I had one more point about that I really wanted to make. We talked about the process and how important, or the fact that there is a process
Mhm.
that founders really need to know and understand. And I feel like the process is using capital as a tool that's appropriate for the stage and the result that you want, right? So they have that chart or whatever that's like pre-seed funding is perfect for product launch, seed funding is for product market fit,
Yep.
series A is for massive scale. So not only do you have to know whether you're VC fundable, whether you fall into the track record or traction,
Mhm.
but then you have to know how to allocate that capital and use that capital as a tool for the stage that you're in
Yeah.
as well
Yeah.
to get you to the next stage. So there's like, yeah, that's these are the nuances of raising venture capital, I think, that are really important for founders out there to know.
There's a really good telltale that I like to use. So when founders work on a pitch deck, they usually have a slide at the end for the ask, right? How much they're asking for, how much they're raising. Most founders, they're going to use a pie chart saying, okay, we're going to spend 20% in marketing, 30% in, it's always the same, right? A third for marketing and sales, a third for tech, and a third for whatever, and buffer. And they add some buffer to show that they're smart. Okay, which is cool. The smart founders, what they do, well, not smart, like experience. It's all experience. There's nothing brilliant about it. It's just that you've been through it. So the experienced founders raising $1 million to get to 2 million ARR in 18 months. So they're already signaling that they know where they need to be in 18 months because they are expected to raise again, and they know what the number is that will, sound good. And this is much more powerful than a pie chart that is, that doesn't mean anything because it's too generic, and we don't care about it anyway at this point. So these are the little details, right, that show, okay, I know what I'm doing. So telling investors, yeah, I know I'm raising that much, and I know that I'm expected by the industry, not by you in particular, just by the industry standards. I'm expected to 3x and get there within 18 months, so I can raise the next round. And you guys are maybe secondaries or whatever, but you can mark up that line in your spreadsheets. This is a lot of like a million of little things like that, and that's why I keep repeating that thing that is a bit unpleasant, but you have to do your homework as a founder. If you've never raised, you have to learn that shit. There's no way around it. You have to learn it. You cannot outsource that. You cannot, pay someone to do it for you. You can get some help for sure, right? Lawyers, advisors, designers, whatever. But you're the owner of that raise, and you are the person who has all the pieces of the puzzle in your mind. So a lot of people ask me, okay, I want to raise, right? They wake up one morning, okay, we're ready. It's time to raise. But they don't know the basics of venture capital. They don't know what the LP is. They don't. If I ask, 220, what does that mean? They don't know. And sure, you don't need to know what 220 is to build a successful business, but it's better. It's yet another signal that you don't understand exactly the game you're playing. And so these are, for me, signals that someone is ready or not. And so in that case, yeah, here are some links, right? Read, learn. Just take a few more days, like take a weekend off. Don't raise right now. Postpone that a few days, and really go deep, understand what you're committing to.
I just put one of my founders through a rigorous course where, yeah, like Neo in the Matrix, I put him in the chair, I like plugged him into the thing, and I taught him like all the martial arts, raise jitsu, and he just did a successsual raise. Yeah.
Yeah.
Like within 60 days. He wanted to originally
Nice.
do it in 30. I was like, that's crazy. Like, I
That's
was
great.
like, there's no way that's gonna happen. He spent 30 days learning.
Yeah, but that's the thing, right? You know that I think it's an American president. Like, if I had a week to cut a tree, I spend 5 days shaping my eye.
Sharpening my axe.
Yeah.
Yeah.
So yeah, there's something like that, and a lot of people just again, it's just popular culture makes it feel like it's easy, and also VCs make it feel like they're friendly and approachable.
I think the problem actually is also with founders. They treat VCs as ATMs. They think that when, like I have a company, again, it may be a beautiful baby, it may not be a beautiful baby. Whether it is a beautiful baby, it actually is a beautiful baby by VC standards, is to be determined. But they think that they have something venture fundable all the time, and they think that because they have a great business, that just means that the capital is just like right there. They just go push a button and it just pops out. Like, but it just doesn't work that way.
Yeah. Founders are always obsessed with their customers or their users, right? They're going to go to great length to learn about them. They're going to interview them. They're going to watch, videos of the founder going through stuff. Because they want to sell to those people. Well, when you're raising funds, you're selling shares of your company, some shares, right? So it's a sales process. And just like in any sales process, you need to know your client. And that's why, what I said earlier, 220 and all that stuff, it's not to be pedantic. It's just that you need to understand how your client thinks if you want them to buy your product. So when you're raising funds, you're selling a financial product you have built, right? You packaged it, and you're selling a financial product. So you're in that business. But founders, they don't treat their investors like they would their clients or their users. Another example of that, pitch deck design, right? And website design. So founders will obsess over the homepage and getting the message right, having a clean design. So their website will look clean because they recognize the value of clear messaging and clear design for their clients. They're gonna put out an ugly ass pitch deck, with a ton of text, impossible to digest, because for them they don't treat the VC or the investor, angel, whoever, family office, as a client, because they don't recognize the fact that they are selling them shares. I think a lot of that could be solved if they recognize, okay, I'm selling a financial product on the venture capital marketplace. And so, there are standards, and I need to be curious about my clients, investigate them. I need to have proper marketing materials. A pitch deck is a marketing material. You're marketing your fundraise. And but you know who's good at that?
And your company
People
is
who
the product.
Your company is a product. Your product is a product, and
Yeah.
the company is a product as well. And where you're doing
Yeah.
two sales
Yeah.
in parallel. Who's good at that? People who've done enterprise sales, people who've sold, like high ticket software, stuff like that. Complex sales funnel with multiple stakeholders and stuff like that, because they understand, okay, that it's all about relationships, and that you need to, it's a long-term process. But founders, I think a lot of founders, they are consumers first, especially the younger ones. They have rarely been on the enterprise side of things. What they know, their mental framework for most things is download an app and one-click checkout. And they kind of hope or wish or expect they can reproduce that same buttery experience with fundraising, right? I can just download an app, and then I'm going to have investors send me requests, and I can just pick which term sheet I prefer, within 24 hours. And I want a nice UX. It doesn't work like that. But a lot of people it's not a cultural background, because they didn't have a lot of enterprise experience. It's a cultural thing, I think. And I wish it would be possible. It's just not how things work.
Yeah. But I feel like the one thing that founders need to know is that anyone can learn to fundraise. So you don't need to be Erlich Bachman from Silicon Valley to to fundraise. As long as you take the time to study, you learn the process, you learn the steps in the process, and you practice. There are lots of advisors out there. Steph from OpenVC has a great platform. I'd love for you to share with everyone a little bit more about the OpenVC platform, and where they can find it, what to expect from it, and that sort of thing. So
Oh,
please.
absolutely. So openvc.app is where you go, and you're going to find tools to help you raise. So when you're actively raising, you're going to find investor lists that are free to use. You can sort investors by check size, geography of interest, and all that data comes from the investors directly. So we have them fill up the information. You're going to find other tools like pitch deck tracking. If you want to send your pitch deck to investors, you're going to be able to track when they open it and all that stuff, which today is really necessary. You're going to have a fundraising CRM, so you can run the whole process in one place. And we've really optimized it. I'm pretty nerdy about it, in a way that is very efficient for founders to raise. This is really a purpose designed, so purpose built tool, right, for venture early stage fundraising. And on the other half of OpenVC, you'll find content. So you'll find a lot of tutorials, step by step, how to do this, how to do that. Okay, valuation. How do I determine my valuation? And valuation in Argentina is not going to be the same as in New York City, right? And valuation in, so you have, like we said, advice is very contextual. And so we try to really break it down into very small kind of decision trees to help you understand, okay, this is the answer, and this is why this is the answer. And this is really built for everyone who wants to raise from angel round to Series A. So that's what we do. Other good resource that I'm happy to recommend, Y Combinator. They have a lot of great content, and they have a YouTube channel, YC School, which I think is maybe not as actionable as our stuff, because they talk to people who already have much of the context. No, to be honest, I love what they do. And obviously, they are a huge name. Everything they say is correct, but I would say with OpenVC,
But you're better.
No. We're not. Factually, we're not.
Mm.
But I think OpenVC is great if you really want to go into the nitty gritty and a breakdown. Step 1A, 1B, 1C. This is really very detailed. And YC is great because you're gonna have probably more big names, war stories, but it's maybe less tutorial-like versus the content.
Yeah. Yours is more robust for another.
Yeah, I think if you use both, you're really covering like 80% or 90% of what you need to know, and you can just browse that over the weekend. Everything is free, so you have, honestly, there's no excuse at this point. It's now you cannot say you didn't know.
Awesome, Steph. So his contact information, the link to OpenVC, the link to the fundability test will all be in the show notes below for everyone out there. Steph, thank you so much for joining me on the show today. Really appreciate the conversation. Really appreciate the connection. It's been an awesome time.
Thanks, Omeed. It was great.
For everyone out there, it's been another episode of SaaS Buyers Club. Thanks so much for tuning in, and see you next week.